Hello everyone. Welcome to today's lecture on one of the most fundamental concepts in GST, the value of supply. This is a crucial topic that every tax professional, business owner and student needs to understand thoroughly. In today's session, we'll explore how to determine the correct value of supply in different scenarios. We'll understand when to use transaction value, what needs to be included or excluded, and how to handle complex situations involving related parties, non-monetary considerations, and agent relationships. By the end of this lecture, you will have a clear understanding of the GST valuation rules and be able to apply them confidently in real-world situations. Let's start by understanding what we aim to achieve in today's lecture. We have 6 key learning objectives. First, we'll understand the value of a taxable supply when it's made to an unrelated person with price as the sole consideration. This is the most straightforward scenario. Second, we'll identify what needs to be included and what should be excluded from the value of supply. This is where many people make mistakes. Third, we'll determine when discounts can be included or excluded from the value of supply. Discounts have specific conditions that must be met. Fourth, we'll learn how to determine value when consideration is not wholly in money. Think of barter transactions or part exchange deals. Fifth, we'll explore the valuation rules for supplies between distinct or related persons, excluding agent relationships. And finally, we'll understand the special valuation rules that apply between principal and agent relationships. Now let's start with the simplest and most common scenario: supplies to unrelated persons. When we have a transaction of supply of goods or services between two unrelated persons and the price is the sole consideration for the supply, the value of supply is simply the transaction value. This seems straightforward, but let me clarify what transaction value means. The transaction value includes not just the amount that has already been paid at the time of supply, but also the amount that is payable but not yet paid at that time. So even if payment is pending, the full agreed price forms the transaction value. Section 15 of the GST Act provides detailed guidance on what should be included and excluded from this transaction value, which we'll explore in detail. Before we move further, we need to understand who are considered related persons under GST law, because the valuation rules change when dealing with related parties. The law provides a comprehensive definition of related persons. Let me walk you through each category. First, officers or directors of each other's businesses are considered related. This includes company directors, managing directors, and key managerial personnel. Second, legally recognized partners in business. This covers all forms of business partnerships. Third, persons in an employer-employee relationship are related parties. Fourth, any person who directly or indirectly owns, controls, or holds 20% or more of the voting stock or share in both entities. Fifth, when one person directly or indirectly controls the other. Sixth, when both persons are controlled by a third person, directly or indirectly. Seventh, when together they control a third person. Eighth, members of the same family are related persons. And finally, when one of them is a sole agent, sole distributor, or sole concessionaire of the other. Understanding these relationships is crucial because it determines which valuation rules apply. Now let's understand what needs to be included in the value of supply according to section 15(2). There are five main categories of inclusions. First, taxes and charges. Any taxes, duties, cesses, fees, and charges excluding GST, if charged separately by the supplier, must be included. Second, supplier's liability paid by recipient. If there's any amount the supplier is liable for, but the recipient pays it and it's not included in the price, this gets added to the value. Third, incidental costs, expenses such as commission, packing, or other charges incurred by the supplier at or before delivery. Fourth, interest or penalty, any interest, late fee, or penalty for delayed payment of consideration. And fifth, subsidies, specifically price-linked subsidies received by the supplier, excluding government-provided subsidies. Let's explore each of these in detail. Starting with taxes, the rule is clear. All taxes, duties, cesses, fees, and charges, excluding CGST, SGST, UTGST, IGST, and GST compensation cess that are charged separately by the supplier, are included in the value of supply. This means taxes that are not subsumed into GST, like municipal taxes, form part of the taxable value for GST purposes. You're essentially paying GST on these taxes too. However, there's an important exception. Tax collected at source under the Income Tax Act is not included in the GST value. This is because TCS is considered an interim levy, not a tax, as clarified by GST Circular number 76/50/2018. So remember, when calculating GST value, include all taxes except GST itself and TCS under Income Tax Act. This is a concept that often confuses people, so let me explain it clearly with an example. Sometimes the recipient directly pays third parties on behalf of the supplier. These payments are included in the value of supply, but only if two conditions are met. First, the supplier must be contractually obligated to pay those amounts to the third parties. Second, these payments must be related to the supply of goods or services. If the supplier is not responsible for that element and the recipient provides it voluntarily, its value is not added. Here's a practical example. A service provider organizing a dealer's meet engages various vendors for catering, equipment, and soft drinks, while the client directly pays the soft drinks vendor. This amount is still included in the value of supply for GST purposes because the service provider was contractually responsible for arranging these services. Incidental costs are charges that are directly related to the supply and are incurred before or at the time of supply. Let me list the main types. Commission paid to an agent and recovered from the buyer is included. Any packing charges billed to the recipient are included. Inspection or certification charges, if incurred before or at the time of supply, are included. Installation and testing charges at the recipient site related to the supply are included. Other charges like weighment, loading, designing, etc., incurred before or at the time of supply are included. For outward freight and transit insurance, if the supplier delivers goods to the buyer's premises and arranges transport and insurance, it becomes a composite supply with goods as the principal supply. GST applies to freight and insurance at the same rate as the goods. However, on an ex-factory basis, if the buyer arranges and pays for freight and insurance, These costs are not included in the value of supply. When payments are delayed, suppliers often charge interest, late fees, or penalties. These are also included in the value of supply. The value of supply includes the base price plus any charges for delayed payment. An important point about timing: the time of supply for such interest, late fee, or penalty is the date when the supplier actually receives these delayed payment charges. The tax rate applicable to these charges is the same as the rate applicable to the main supply of goods or services. Moving to subsidies, the rule is specific. Only subsidies directly linked to the price of goods or services are added to the value of supply of the supplier who receives the subsidy. Blanket subsidies or donations received are not includable in the value because they are not directly linked to the price. Most importantly, if the subsidy is given by the state or central government, it is not to be added to the value of supply. This is a significant exception that protects government welfare schemes from GST implications. Now let's understand when discounts can be excluded from the value of supply. This is governed by Section 15(3) and has specific conditions. For discounts given before or at the time of supply, they can be excluded if the discount is shown in the invoice for that supply. This is straightforward. For discounts given after the supply, the conditions are stricter. The discount can be excluded only if: first, the discount is established through an agreement made before or at the time of supply and is linked to specific invoices. Second, the recipient has reversed the input tax credit related to the discount as per the supplier's document. Both conditions must be satisfied for post-supply discounts to be excluded. The essence of these conditions is that the price established at the time of supply should form the basis of value. This ensures consistency and prevents misuse. If any of the conditions for post-supply discounts are not satisfied, the GST liability of the supplier cannot be reduced. However, suppliers can still issue financial or commercial credit notes even if these conditions are not met. Such credit notes don't include GST and don't impact the value of supply for GST purposes. An interesting clarification comes from insurance companies' no claim bonus. Insurance companies disclose NCB in policy documents and invoices. Since this involves pre-disclosure and specific mention in the invoice, it qualifies as a deductible discount under Section 15(3)(a). Let me explain some specific types of discounts and their treatment. First, staggered discounts or buy more, save more schemes. These are discounts that increase with purchase volume, like 10% for purchases above 5,000 rupees, 20% for purchases above 10,000 rupees. These are excluded from the value of supply if shown on the invoice. Second, volume discounts based on yearly purchases. These are additional discounts offered to stockists based on total yearly purchases, like 1% discount for buying 10,000 pieces in a year. These discounts are established via agreement before supply but determined after supply, typically at year end. They are excluded from the value of supply if they meet Section 15(3)(b) conditions and ITC reversal is done by the recipient. Third, secondary discounts or post-supply discounts. These are discounts not known at the time of supply or offered after supply completion, like revaluing a product post-sale. These cannot be excluded from the value of supply because they are not known at the time of supply and don't satisfy the conditions laid down in Section 15(3)(b). The key principle is that the value should be determinable at the time of supply for proper GST compliance. Sometimes the transaction value under Section 15(1) cannot be determined. This happens when the transaction involves a related party or the price is not the sole consideration as per Section 15(4) or for notified supplies as per Section 15(5). In such cases, we need to use prescribed valuation rules. These rules are categorized as Rules 27 to 29, supplemented by Rules 30 and 31. Deal with valuation of supplies involving non-monetary consideration or related parties. Rules 31A, 31B, 31C, and 32 deal with valuation of specified supplies. Rule 33 covers valuation of supply made as pure agent of the recipient. Rules 34 and 35 cover other relevant aspects of valuation. When consideration is not wholly in money, Rule 27 provides a hierarchy of valuation methods to be applied in order. First, use the open market value if available. Second, use the total of consideration in money plus an amount equal to the consideration not in money. Third, use the value of supplies of like kind and quality. Fourth, use consideration in money plus money value of non-monetary consideration computed as per Rule 30 or 31 in that order. This hierarchy ensures that we get the most accurate market-based valuation. Let me clarify the key terms used in Rule 27. Open market value means the full value in money, excluding GST, for a supply between unrelated persons with price as the sole consideration. This is the benchmark for fair market value. Supply of goods or services of like kind and quality refers to a similar supply made under comparable circumstances, closely resembling the valued supply in characteristics, quality, quantity, functionality, and reputation. These definitions ensure consistency in valuation across similar transactions. When value cannot be determined by preceding rules, we use Rule 30 and 31. Rule 30 states that where the value of a supply is not determinable by any preceding rules, the value shall be 110% of the cost of production or manufacture, cost of acquisition of goods, or cost of provision of services. Rule 31 is the residual method, also called the best judgment method. The value shall be determined using reasonable means consistent with the principles and general provisions of Section 15 and valuation rules. For services, Rule 31 can be adopted before Rule 30, providing flexibility in service valuation. For supplies between distinct or related persons, other than agent relationships, Rule 28(1) provides the valuation hierarchy. First, use the open market value. Second, use the value of supplies of like kind and quality. Third, use the value as per Rule 30 or 31 in that order. There are special provisions too. For goods intended for further supply, the supplier may opt to value them at 90% of the price charged by the recipient to their unrelated customer. If the recipient is eligible for full input tax credit, the invoice value is deemed the open market value. Rule 28(2) deals with corporate guarantees. For corporate guarantees provided by a supplier to a related recipient in India, the value is either 1% of the guarantee amount per annum or the actual consideration, whichever is higher. This ensures that corporate guarantees are properly valued for GST purposes and prevents undervaluation of such financial services. Rule 29 governs valuation between principal and agent. The value of supply of goods between principal and agent shall be the open market value or at the supplier's option 90% of the price charged for supply of goods of like kind and quality by the recipient to unrelated parties where goods are intended for further supply. Where value is not determinable under this clause, it shall be determined under Rule 30 or 31 in that order. This recognizes the special relationship between principal and agent and provides appropriate valuation methods. Finally, let's cover the remaining valuation rules. Rule 34 deals with rate of exchange for determination of value. For goods, use the rate notified by CBIC under Customs Act on the date of time of supply. For services, use the rate as per generally accepted accounting principles on the date of time of supply. Rule 35 deals with value inclusive of taxes. Where the value of supply is inclusive of CGST, SGST, UTGST or IGST, the tax amount is calculated by making back calculations using the formula tax amount equals value inclusive of GST multiplied by applicable GST rate divided by 100 plus applicable GST rate. That brings us to the end of our comprehensive lecture on GST value of supply. Today, we have covered the fundamental principles of GST valuation, starting with the basic concept of transaction value for supplies to unrelated persons. We explored what needs to be included in the value of supply, such as taxes, third-party payments, incidental costs, interest and penalties, and subsidies, and what can be excluded, particularly the detailed rules around discounts. We then delved into the more complex scenarios involving non-monetary consideration, related party transactions, and special relationships like principal-agent arrangements. We also covered the hierarchy of valuation rules when transaction value cannot be determined, including the application of rules 27 through 35. Understanding these valuation principles is crucial for accurate GST compliance and will help you handle even the most complex valuation scenarios with confidence. Thank you for your attention, and I hope this lecture has provided you with a solid foundation in GST valuation rules